Hi, welcome to this tutorial. I'm going to talk about how you can achieve financial freedom by building a dividend income portfolio. So the first question to ask is, what is financial freedom? Financial freedom is when your passive income is able to exceed your expenses. And when that happens, you have the choice to be able to not work and be able to fund your lifestyle indefinitely. So it doesn't mean that we don't work. Of course, we still work because we need something to do. But the power is in the choice that we do things that we love to do. So what does it take to achieve financial freedom? So the first thing you have to ask yourself is, what's your lifestyle? What are your expenses that you need to cover? And it's different for different people. So, for example, you may say, I need $3,000 a month to fund my lifestyle. So take 3,000 multiplied by 12, that's $36,000 a year. So that's step one, find out your annual expenses, 36,000. Then the next question would be, how much capital do I need in my dividend portfolio to generate $36,000 a year? Well, it depends on the yield or the dividend yield you're getting on your portfolio. So for me personally, I look at a yield of at least 6% in my overall portfolio. That is what I've built in my own portfolio. So if you take 36,000 and you divide by 6%, you get $600,000. So in other words, if you get a 6% yield on your portfolio, you need to target to build a $600,000 portfolio. Now you may say, how do I build 600K? It doesn't happen overnight. It takes time, it takes effort, but you can get there sooner than you think. So how long will it take to get there? It depends on how much you save a month, and it depends on the rate of return of your portfolio. I'm going to give you a few numbers based on my own experience. So let's imagine you can save $1,000 a month. Some of you may save more, some may save less, but let's take $1,000 savings on average a month. That means you save $12,000 a year, correct? So if you save 12K a year, how long will it take to hit 600,000? Depends on how much your 12K grows. So let's take a very conservative 10% growth a year. If you just buy the S&P 500 index, hold it through the ups and downs, you get about 10%. If you buy high quality dividend stocks, you could get a 5% yield, 6% yield, plus a bit of 4% capital gain. That's about 10% as well. Again, this is based on my own experience. Invest 12,000 a year, growing at 10%. How long will it take to hit 600K? Well, you need a financial calculator or Excel spreadsheet, but I'll give you the answer. The answer is you need 17 years, right? Now you may say, is that a long time? Well, that's okay. So think about it. If you are 30 years old today, in 17 years you'll be 47, which means by 47, you're financially free, right? If you're 40 years old, you start now, at 57, you're financially free. And that's better than what most people will achieve. Most people, they don't know how to grow their money. They just put their money in the bank. They get a low interest rate. By the time they're financially free, could be never, or maybe in their mid-60s. So if you want to achieve that earlier, then this is the plan. So how do we achieve this 6% overall yield on our portfolio? Here's where I can share with you how I do it. Now, personally, my dividend portfolio that I've been building now over 25 years, it generates for me about $406,000 in passive income every year. And that covers all my expenses. So roughly, I'm getting a 6% yield on my assets. So you can guess, right? So roughly my assets is about $6.8 million. 6% yield, I'm getting $406,000. And again, this didn't happen overnight. It took me many, many years to build this portfolio. But I'm going to share with you exactly how I did it. And I actually created an income investor course where I teach step by step how to build this portfolio. But in this tutorial, I'm going to share with you some of the basics of what you can start to use to build your own portfolio. So in my dividend income portfolio, it consists of 4 main income assets. Number 1, high quality dividend stocks. Number 2, high quality REITs or real estate investment trusts. Number 3, private credit. And number 4, bonds. So let me explain these 4 income assets one by one. But first, you have to understand the concept of yield. What does yield mean? So let me give you an example. Yield is the cash that you receive a year divided by the price of the asset. So for example, if you buy a stock that is selling at $10 in the market, and this stock you buy pays you $1 of dividends a year. So what's the yield? You get $1 dividends a year out of $10, that's a 10% yield, right? If the stock pays 50 cents a year in dividends, 50 cents a year divided by $10, that's a 5% yield. So that is the meaning of yield. So the first asset that gives you yield would be dividend stocks. Now, first, when you buy a stock, what are you actually buying? When you buy a stock, you're buying a piece of a business. Always remember that. So dividend stocks means you're buying a part of a business where they generate profits every year and they pay out a part of their profits as dividends. So that's the first thing I own. Now, for dividend stocks, what is the kind of yield that you can get in the market? Well, I would say it ranges from 3% to 6%. Again, you can get those more than 6%, of course, but I'm talking about high quality businesses. So for high quality businesses, I think 3 to 6% is a good range. And it depends on which markets. If you look at the US markets, high quality dividend stocks would probably be about 2 to 3%. But if you look at other markets like Singapore, one good thing about the Singapore market, which I'm living in, is that it's got some of the highest yielding dividend stocks where you can get 5, 6%. So, for example, in the Singapore market, some of my favorite dividend stocks are actually the Singapore listed banks like DBS, UOB, and OCBC. They've got a very good history of consistent growth in their earnings. Now, generally, banks are cyclical, but the Singapore banks have been very good in managing their cyclicality. So in other words, even in past recessions, they're still able to make pretty good money and their dividends are still very, very consistent. And for Singapore listed banks, if you buy at the right price, you could get a yield of about 5 to 6%. Now, of course, not always. You have to wait for the right time to get it, and that's what I do. I wait for the right time, 5 to 6%, I'll grab these high dividend paying stocks. The second asset, which I built over the years, are real estate investment trusts, or REITs. So what does it mean? Now, many of you would have heard that property is a great way to get passive income. So you buy a property, you rent it out, and you collect rental from the tenant. Now, you can do that, of course, but I don't own physical property besides the one I'm living in, because physical property, there's a lot of effort involved where you have to renovate the property, you have to find a tenant, you have to chase for the rent. If the water heater breaks down, if you repair the water heater, to me, it's too much work. And that's not passive income, there's a lot of active income. So I find the simplest way to invest in property is to buy a real estate investment trust. What that is basically a concept where a fund called a REIT, they will pool money from many investors and they'll buy a portfolio of properties. Whether it's retail properties or office properties or logistics properties or data centers, they rent it out, they get a rental, and they share among the shareholders. So these are REITs. So again, you can buy REITs on the US markets, Singapore markets, the Hong Kong markets, many markets. And I find that some of the highest quality, high yielding REITs are from Singapore as well. So I love to invest in US stocks for growth, for capital gain, but for yield, I find that Singapore market is actually very, very attractive. So for high quality REITs, again, what kind of yields do I look for? I look for yields of between 5% to 7% yields on real estate investment trusts. So let's recap. You can earn passive income by owning businesses that generate profits and they pay you the profits in dividends. Those are called dividend stocks. Or you can own real estate where you collect rental income through REITs. The third way to collect passive income is to lend money, is to be a lender. So when you lend money to people, they pay you an interest, and that interest is passive income. So how do you lend money to people? There are two ways to lend money. One way is to do what we call public lending, and the second is private lending. What's the difference, right? So public lending is what we call bonds. So for example, if you buy a government bond, you're lending money to the government, they pay you a fixed interest called a coupon. If you buy a corporate bond, you're lending money to the company pays you a fixed interest, that's a corporate bond. Now, bonds are traded on the market, so we call them public assets. They are public lending assets because you can trade them publicly. So I own bonds as well. Now, I also own what is known as private credit. Private credit is known as private lending or direct lending. So these are funds where they lend money to small and medium-sized companies with a high floating interest rate, and these loans are not listed. That's called private credit. Now, I own both bonds and private credit. For private credit, the yield is about 8 to 10% a year on average. And I'm talking about high quality private credit. For bonds, it's between 4 to 6%. Now, some people often would ask, why is it private credit you have got much higher yield of 8 to 10%, whereas bonds is like 4 to 6%, or in fact, some bonds are even less than 4%, right? So people get the impression that private credit is more risky. That's why you get a higher yield. That's what I used to think. But through my research and through my own investment, I found that private credit is perceived to be more risky. That's why it's got a higher yield. But if you know how to select the right private credit funds, it's actually not more risky than bonds. In fact, in my opinion, they can be less risky than bonds. And I'll explain a lot more in the income investor course. But let me give you an example of why. The reason bonds are considered less risky is because they have got higher credit rating. If you've heard of what we call AAA, AA, triple B. So because of the high credit rating, they offer lower yields. But private credit does not have this credit rating. So people think it's more risky. But in actual fact, if you invest in a high quality private credit, their loans that they give are secured loans. That means they lend money to other companies, but it's secured by collateral. And they are first lien senior secured loans. In other words, if the borrower doesn't pay the money, they have a claim over the collateral, over the asset. And the loss ratios are actually very low for the high quality private credit. And I'll show you what are some of the ones that I actually invest in. At the same time, bonds may look safe, but remember what happened to Lehman Brothers bonds. Remember what happened to high flux bonds. They all went to zero, right? Because the trouble with bonds is that they are maybe rated triple B or double A, but they are not secure. In other words, when you buy a bond, there's no collateral. If the company goes bust, you get nothing back. So same thing, don't think that bonds are all safe. Some bonds are very risky. You only want to buy bonds of very, very safe companies that have got low debt, they've got very consistent profits, that are able to consistently grow their income and their revenue. So when I buy bonds of companies, I make sure that these companies are resilient, they are defensive, and they're not too cyclical. So by having a right combination of these four assets, on average, my portfolio yield is about 6%. So some people ask me, Adam, why don't I just invest in REITs? Why do I need to invest in private credit and bonds and stocks? Why don't I just buy REITs? So the reason is this. Remember, as an investor, the most important key is diversification. Because we can't predict exactly when the next recession will come. We can't predict whether interest rates will go higher or go lower. We can't predict all these things. So our job as an investor is to build a portfolio that's well balanced and diversified such that no matter what happens, high interest rates, low interest rates, economic growth or recession, our portfolio will be resilient. So let me give you an example. Imagine if you only invested in REITs, 100% REITs. What would have happened in 2022? You may have gotten a heart attack. In 2022, when the Fed raised interest rates aggressively, most REITs did not do well. Because when interest rates are very high, REITs, they have to pay a lot more interest cost on the loans that are used to finance the property. So their interests go up, their income goes down, they have to pay less dividends, the property value goes down, the REIT prices drop. So a lot of the REITs in Singapore, even the good ones, the share price dropped a lot in 2022. But while the REIT prices dropped, guess what happened? Private credit did very well because private credit does very well when interest rates are very, very high or they are going up. And when interest rates are going up, banks did very well as well. So by having a good diversification, my REITs went down in 2022, but my private credit as well as my banks went up and it offset the temporary drop in my REITs. But now in 2025, interest rates are coming down, my REITs are rebounding. Now, banks are not collapsing, but they're not growing as much. But they're still doing pretty well. And private credit is also stabilizing. So by balancing, I find that in any situation, I'm able to generate consistent income from my portfolio. So if you take a look at the four asset classes, you'll realize that if you buy good dividend stocks, the dividends will grow as well. They'll pay more dividends every year. If you buy high quality REITs, their dividends will also grow every year. If you buy high quality private credit, they will also pay more dividends every year. The only thing is bonds. The coupons they pay are fixed. It doesn't grow. The coupons are fixed. Right? So among the four assets, I would say that bonds are the ones where the interest doesn't go up. It stays the same. They may say, then why you want to buy bonds? So in fact, in my portfolio, bonds have the lowest allocation. But I still have some of them. Why? Because one good thing about bonds is that bonds do well in a recession. So when we enter a recession, no one can predict when, but we will always go through recessions from time to time. In a recession, the Fed will cut interest rates, and that is when bonds will do very well, and they'll offset the temporary weakness in dividend stocks as well as REITs. And that's why it's very important to have a well-diversified portfolio. So the most important thing, remember, is to get started. And the first thing you need to do is to educate yourself to make sure, again, you buy the highest quality assets. What are the criteria to select the best dividend stocks? The criteria to select the best REITs? The criteria to select the right and the best private credit and the best bonds. So how do you learn this stuff? Now, I took many years to learn it, but thank goodness I put it together in a course called the Income Investor course so that you can cut short your learning curve. You don't have to take 5, 10, 15 years to learn this stuff. You can learn this all over one weekend by taking this course. And this course, by the way, is an on-demand course where you can watch it anytime, anywhere, and you have got a lifetime access to the course materials, and you can learn at your own pace. And we also have got a community chat group on Discord where anytime you got questions, you can ask questions. I'm there, so are our fellow students. So first step, get educated, learn about how to buy the highest quality assets. That's the first step. The second step is to have a goal of how much you can save every month, every year, and then have a goal of how to deploy it into these assets. So in other words, starting right now, you may want to start investing in some high-quality dividend stocks, some high-quality REITs, some high-quality private credit funds, and some high-quality bonds. So when do you invest? You invest when the assets are undervalued, when they go below their intrinsic value and they retrace to their support levels. And this is something that you're going to learn in the Income Investor course. How do you value a stock? So for example, like I mentioned, Singapore banks, right? Like DBS, UOB, OCBC. But right now, is it the time to buy? Maybe not right now, because right now they're a bit overvalued. So you got to have a target where once it drops below this price, it's undervalued, you can start buying it. By the way, I think that some China banks are also very attractive. Like the Bank of China is another dividend stock that I own. And I've been adding it recently because it recently dropped below the intrinsic value. And that's when I started adding it. So again, it's not about guessing. It's about knowing how to calculate the intrinsic value, knowing how to set the buy levels and going to buy. So these are things that you can learn. Another example again are REITs. So if you look at the REITs right now, some of them are already overvalued, but some of them are still undervalued. So again, how do you calculate the intrinsic value of REITs? How do you select the buy levels? And once they drop, that's when you accumulate the REITs. So these are all the things you're going to learn in the Income Investor course. The good thing is that you don't need a lot of capital to start building a dividend income portfolio. The good news is that nowadays you can actually start without any minimum amount required. So let me give you an example. If you want to buy REITs, what's the minimum you require? Well, some of the high quality REITs in Singapore, they're selling at about, say, $2 a share. And the minimum is to buy 100 shares. That's the minimum, right? So 100 shares times $2, what's your minimum investment? $200. So all you need is $200 to start investing in REITs, for example, listed in Singapore. If you want to invest in private credit, through what we call BDCs or business development companies. Well, many of these private credit are listed in the US markets. One of the ones that I bought is called Blackstone Secured Lending Fund, and it's now selling at about US $27. And in the US market, the minimum is to buy one share. So what's the minimum investment? One share, $27. If you convert it to your own local currency, you can check it out. Like you convert it to Singapore dollars, that's maybe about $33. You can start investing. So you can see that you don't need tens of thousands or hundreds of thousands to start investing in income assets. You just need 27 US, or you just need $200 Singapore dollars to get started. So get started now, because the earlier you start, the more time you have for your money to grow and compound, and the earlier you're going to hit your financial freedom target. The last point I want to mention is this. Remember that if you buy, for example, a dividend stock that has a yield of 5.5%, which is normally what I like to get, right? Remember that if you buy a good company, the dividends will grow. Look at DBS, for example. When I bought DBS many years ago, the dividend yield at the time was about 5.5%. But the dividends are growing at 12% a year on average. So every year I get more dividends, more dividends, more dividends, and in 5 years, my actual yield on my cost of purchase is about 9.7%, almost 10%. And in 10 years, my yield on DBS shares on the cost is about 17%. So it's very, very powerful. So imagine if you start buying the right dividend stocks today, in 5 to 10 years, your yield on your capital would grow to 17 to 20% yield. And that is really, really very powerful and fantastic. And that's how you can reach your financial freedom target a lot earlier than you realized. So to learn more about this, you can check out my Income Investor course. It's just launched to the public, and you can click on the link below to find out more. And hope you enjoy this tutorial and learn as much as you can in the Income Investor course.